Hey YouTube, hit the weights room today. Sorry if it's a little bit echoey, it's a bit echoey in the room, but today I'm going to be answering the question, what would it take to pay off the world's debt? And what would happen if we did pay off the world's debt? And I'm going to play that into a few scenarios of how this could happen and what that means to you. So let's get right started. The current level of global debt is approximately $300 trillion. Now, we've got a little bit complacent about numbers recently. It was way back in 2012 when I first went on and gave a TEDx talk where I tried to help people conceptualize. In 2012, this is when we were talking billion-dollar bailouts rather than trillion-dollar stimulus packages. And in the billion-dollar bailout days, I was trying to help people conceptualize where the debt was going and what it actually means. So $300 trillion of debt just seems like a number out of the blue. Let's try and conceptualize that, and I'll do exactly what I did during that TED Talk all those years ago in 2012. So if you took every dollar and represented it by a second, then if you said $1 million, let's just start with $1 million. $1 million translated into seconds is approximately 12 days. So that gives us a frame of reference for understanding 300 trillion. So then what is $1 billion? Well, $1 billion translated into seconds is the difference between 12 days and 31 years. So think about your life. How far does 12 days feel away relative to 31 years? That's the difference between a million and a billion. Some of you are not even 31 that are watching this, so it's more than your entire life in terms of time frame. Now let's translate that into trillions. So how many seconds is 1 trillion? Well, it's actually over 31,000 years. To put that in context, that's before humankind. 31,000 years is the difference between a million, a billion, and a trillion. So it really is an order of magnitude greater. So when the US is announcing these trillion-dollar stimulus packages, this is deflating, inflating away the value of your savings significantly. So these numbers are now, where are we at right now? We've got 300 trillion of global debt. That means that the world is approximately 9.3 million years in terms of the debt. If you could pay off $1 every second, it would take 9.3 million years in order to do this. So 300 trillion in debt. Firstly, how would we have a ginormous shift? Well, first you've got to understand the rules of money, and if you've been watching my YouTube for a long time, so I was in the gym today really thinking about these numbers and different scenarios. You'll know that money is created as debt, so this just represents the amount of money that a private bank and various other institutions have created. Because every time you borrow money from a bank, a new dollar or pound or euro is created. And so this debt is proportionate to the money creation mechanism. So in order to pay down that debt, and whether that would be a desirable outcome or not, I'll be going through in this video, would require the shrinking of a money supply on a scale we have never seen before. So to shrink the money supply by 300 trillion would be complete disaster for every single global country in the world. That would be, financial Armageddon for the world. So it would have to be followed by a radical monetary and banking reform. So when I published the book, Bank to the Future, Protect Your Future Before Governments Go Bust, over a decade ago, I talked about a deleveraging effect by governments or central banks issuing non-debt-based currency. And so governments and central banks governments particularly have every right to issue currency not backed by debt, but instead they outsourced it to the private banking sector and borrowed it to repay it plus interest, factoring in a ginormous inefficiency of interest into the economy. So let me be crystal clear here. Debt in itself is not a bad instrument when used correctly. Money created as debt is what I call the world's largest regulated Ponzi scheme, where we've implemented laws and regulations in order to try and control and rehypothecate a Ponzi scheme that's inevitable, predictable, and guaranteed to crash, burn, and fail at some point. So what are they going to do when it does? Well, firstly, you've got to look at the delicacy of the financial system. When you have $300 trillion of global debt, and you have those consolidated in pockets of large debt, for example, the derivatives market, or for example, in 2007, we had the mortgage markets with mortgage-backed securities, then you just need something to go wrong in one of those, and it has an impact because all financial products are interconnected through the wizardry of the financial system. And so the next domino, it could be the pension crisis. World's another thing that is not sustainable and has very big challenges ahead. Student debt. It could be a tiny little country like Iceland during the last financial crisis, creating systemic risk across the whole system, and Lehman Brothers, and then that making its way into the derivatives market and all that stuff. Anyway, I digress. So back to the example, $300 trillion of debt. Well, the couple of ways that you could do that is you need to match it with an equal deleveraging process. So in the book Bank to the Future, it was the very first published book in the world to include Bitcoin, but I talked about government issued currencies as a deleveraging mechanism, and likely ending up in something called modern monetary theory. Now, if I were translating the book back into today's language, that would be putting together the central bank and the treasury, which is the government, combining fiscal and monetary policy in geek language, and then issuing a central bank digital currency connected to artificial intelligence and algorithmically adjusted based upon a deleveraging process. So if, for example, if a bank goes bust, rather than everybody losing their deposits because the bank owns the money, it's not your money if you hold it at a bank, and it's not insured if it's systemic, one significant bank could go bust because they only hold about 1% on reserves in these insurance schemes. Then if a few banks go, then you look to the government to bail out, and then you pay the bill through increased tax and inflation if they decide to increase the money supply through quantitative easing. So at the end of the day, you always pay the bill. And so what if you just had a deleveraging effect? Well, if the bank goes bust, you could just simply say, download this app, whatever balance you had there, you now have in this central bank digital currency, and it's no longer backed by debt. Essentially, when money is either repaid or defaulted, the money supply contracts, because remember, the bank created the money, and as it's repaid, the money supply decreases. And so the deleveraging, this 300 trillion, is the money supply. So you'd have to replace it with 300 trillion of non-debt based money. My forecast is that will come in two forms. The first form, it will come in central bank digital currencies as a mechanism for deleveraging the economy as systemic risk events occur. So here's this funny thing. You don't need to live in fear and anxiety. I'm not here to give you fear and anxiety about the financial future. I'm here to give you solutions, what is likely to happen, forecasts, predictions. The past does not equal the future. I'm just playing around, and that's what I've been doing for the last 2 decades on different financial scenarios. So how do you deleverage $300 trillion? Well, you could probably do that in 2 ways. Firstly, you could do that through central bank digital currencies where governments or central banks, it doesn't have to be, it could be a government issued digital currency, could deleverage and just issue the currency in proportion to the amount of money that blows up as a bank goes bust or any of these pockets of debt hit systemic risk events. That is actually not necessarily inflationary, because one form of money is blowing up and disappearing and another form of money is replacing it, and if it's debt free, then you've taken out all of the interest and inefficiency, and therefore is not necessarily. It is a shift from market driven ways of organizing economy to more communist ways of organizing economy. where you're taking all of these private assets, repackage them, and maybe it comes with the removal of certain private ownership of those assets, but you're deleveraging is the technical financial jargon. So you could do that purely with central bank digital currencies. You could just simply swap out one form of money with another and go through a deleveraging process over time and get banks back to full reserve banking, just like we see in many of the financial institutions that don't have banking licenses and have to operate off full reserves, just like peer-to-peer lending. Then you can move into a world where the only loan that is made is one that's not money created, but somebody that's looking for return, like a peer-to-peer lending product, a collateralized DeFi, decentralized finance product, or any type of collateralized loan. It's more of an investment product rather than the world's largest regulated Ponzi scheme. The second way that could be achieved is by a private form of money becoming significant and generating a wealth effect. So many people in the Bitcoin space that I know, because Bitcoin has a fixed supply of 21 million Bitcoins, and it allows you to own your own money and spend your own money every single year for the last 13 years, and ever since I spoke at the first Bitcoin conference in 2011, I've seen the demand for money you can own, money you can spend, and fixed supply increase every single year. In fact, on average, it's increased about 113% in terms of market capitalization. And because of that, people don't like to spend it too much. So it generates what's known as, rather than a leveraging effect, a wealth effect. And so a wealth effect has been created. The industry is now approximately $1 trillion in terms of Bitcoin and $2 trillion in terms of the entire crypto market. But Bitcoin, because we're focusing on digital hard sound money here, and no other cryptocurrency has a shot, in my perspective, at being digital hard sound money. And so you've got this wealth effect that's been generated. And what we found is that when people generated wealth, they started reinvesting their wealth rather than taking on debt, or they would collateralize it, which means you don't want to sell your Bitcoin. So you lock it up and borrow some dollars against it because you want to hold an asset that you believe in the long term goes up in value, and borrow an asset that you believe in the long term goes down in value. Historically, the dollar has lost 95% of its value slowly through this ginormous contraction of debt and the money supply. And historically, Bitcoin has gone up in value because of its fixed supply and the fact that it allows you to own your own money, spend your own money. And just a disclaimer here, the past does not equal the future. I can't give you financial advice. I'm just tinkering with numbers while I'm doing my workout here. I wanted to share with you at the end. So if you took those numbers, and I'm just doing some mental gymnastics, if you wanted to pay off the entire $300 trillion by people owning some Bitcoin, and Bitcoin generating a wealth effect that led to them paying off all their debt and the deleveraging of all these financial products, I think, and I may have done the maths wrong, this is the danger in doing it mentally while you're doing a gym exercise, but screw it, I'm sure the comments in YouTube are going to tell me everything. I make that about approximately $41 million Bitcoin to deleverage completely if you generate the entire wealth effect, and to generate those 21 million Bitcoins into a $300 trillion market cap. And so, Bitcoin's already at that $1 trillion. It would have to be a 300x from here to get to $300 trillion. And I think way more likely, I probably really screwed up the maths, but hey, that's the danger of doing this live. I'm sure you'll let me know and we'll get the correct maths in the comments in YouTube. But that's one way of getting to that 9.3 million years to pay off the $300 trillion. What I think is going to happen is you're going to get both. I believe that the demand for money you can own, money you can spend, and has a fixed supply increases and continues to go through the 13-year bull market that it's been on. Not financial advice, do your own research. No, past performance is no indicator of future returns. And I believe that we have central bank digital currencies, the two compete. And when they compete, it's a deleveraging effect and war on banks. Both of those means banks lose. At the moment, banks are the winners because they get to create a digital representation of the government's currency every time they issue a loan. 97% of the entire money supply is created by a private bank. They benefit from the interest, and we all lose as a result. They pay us really bad interest rates, and it's all regulated and legalized by the world's largest regulated Ponzi scheme. Eventually, that doesn't stick, and so you have competition from financial currencies or Bitcoin that exists outside the financial system, and you have governments and central banks waging war on banks during the upcoming currency wars, the upcoming monetary renegotiations. And if you haven't checked out all of the masterclass series that I created for free on retirementplanb.com, I got a lot of requests. I was due to take it down last week, but I got a lot of requests to leave it up because not everyone got to watch it. It's literally a 15-hour marathon for immersion. So how does this all play out? Well, if you didn't watch my update yesterday on the Bitcoin volcano bond, I do believe that countries are now going to be using this model, and it's going to have a cascading effect. And I shared the history between why the Bitcoin volcano bond is so much more significant than most people think. And I shared a series of events that have happened over the last decade in a short update like this. I think it was about 20 minutes or so. And I really believe it's worth you investing your time in understanding why today you are alive at one of the most interesting and exciting times in financial history. Some people are going to be on the wrong side of this change, others are going to be on the right, and I want you to be on the right side of that change. So I'm done with my workout. For those of you that are not subscribers, I do an update like this because I'm trying to get you to hold me accountable to my workout because I want to be working out and getting myself in better shape. So I'm going to go up now to start my day, and always remember, you are alive at the most interesting and exciting time in financial history, and I want you to be on the right side of that change. Peace.